Appreciate the opportunity to be here today and share some information with you. Are you able to see my screen, Steve?
Yes, absolutely.
Okay. I always like to start out with a quote to kind of put things into perspective, and Abraham Lincoln said, "You cannot escape the responsibility of tomorrow by evading it today." And I think while this is appropriate for a lot of what we do in the insurance business, I think relative to long-term care, it is extremely apropos given the fact that most folks just don't want to talk about what happens if I get sick and need some type of care, and not talking about it, avoiding the conversation doesn't mean that it's not going to happen, and delaying that conversation just puts everybody kind of behind the curve in appropriately planning for that type of a risk. As Steve said, we are a strategic partner with URL. We focus everything that we do on the long-term care insurance market. That's what we eat, sleep, and drink 24 hours a day, 7 days a week. I've been in the insurance business personally for about 20 years, and probably 19 of those I've been focused almost exclusively on the long-term care market. So whether you're working in the individual market, working with business owners, maybe worksite cases, whether it's group or voluntary, or may have relationships with the association, an association. There are different marketing platforms that we can assist with in targeting some of those specific types of markets that you may be working in with your other lines of business. Just a snapshot of the services and the support that we're able to provide to you relative to the traditional long-term care products. One of the ones that I think we're trying to spend a little bit more time making sure that we're providing you the assistance and support that you need is really that joint sales support. We're quote unquote the experts in the long-term care market, and you have your primary markets that you're working in, and I know enough about a lot of lines of insurance, but I recognize the fact that I don't know great details about some of the other markets, be that the life market, the investment market, or whatever the case may be. And if I'm looking for support in a market where I don't have the expertise, I want to engage that support network or that resource to hold my hand along the way, provide the information that I need so that I can comfortably and confidently talk with my client, but also recognize the fact that it's okay to pull that resource in directly to have conversations with the client. And that was kind of a long-winded way to say, we're here, we're available to do that, whether it's a conference call, geographically, if you're local to our area here. I am in the Harrisburg area as well, about 10 minutes from URL and Steve's office. So geographically, if it permits, we're certainly able to meet with you and your client in person to be that resource if you're having those long-term care conversations. We have a full portfolio of the traditional long-term care carriers, the ones that you're probably familiar with, the ones that your clients are going to be seeking information on, if they're beginning to look at this type of an option. And we've never had more options available to present to our client relative to a solution that addresses that risk and cost of long-term care. There are combination products out there, whether they're life insurance-based or annuity-based. Again, we encourage you to talk with Joe Corio and his team if that type of a solution presents itself as being the right fit for the client. And then obviously with Steve and his team, there are life insurance products with accelerated benefit riders, be that long-term care or chronic illness riders. But it's important to know that when you're talking with us and having those conversations around the different types of solutions, we are fully capable of having those conversations. And if one of those types of solutions presents itself as going to be the appropriate fit, we're certainly going to encourage you and we'll help you engage Joe and Steve in their respective teams, and making sure that you have, again, the information and resources to present the best solution for your client, because ultimately that's really what it's about. It's what's the right fit, what are the right solutions for the client. Just wanted to give you a quick snapshot. This, again, from the homepage of the URL website. If you go to the Departments tab, down into the Medicare offerings, you'll see the long-term care. And if you click on that, that'll bring you to the long-term care page, and you can request a long-term care quote from that. Most states require long-term care continuing education prior to submitting an application. If you're not current on that, certainly by all means give me a call. If you do need to take the training, there's a link that'll take you to some training sites so that you can get current prior to taking an application. I also do a newsletter, typically a couple times a month, so if you would like to view past issues of that newsletter that has all the carrier updates, what's happening in the long-term care market, all of those resources are available to you at that website. So what I want to talk about today is, what's brought us to the current state of the long-term care market. Just some LTC basics, positioning the conversation, giving you kind of a high-level overview of what's happening with the carriers in the traditional market space, and then where do we go from here. And obviously, there's been a lot of discussion, attention to the traditional long-term care market over the last several years, and most recently because of significant rate increases on in-force policies. And there's some real meaningful, I guess, for lack of a better word, there's some real meaningful reasons as to why the carriers are having to take the steps that they're having to take to address the pricing on those older products. The primary reason is the declining interest rates, unexpected low lapse rates, increased claims. The problem is that when carriers price products, be it 10, 15, 20 years ago, obviously when they manufacture an insurance product, specifically long-term care, they anticipate a estimated return on the reserves for that business. And when you look at what interest rates were 15, 20 years ago, they were obviously considerably higher. So as a result of the extended low interest rate environment, it's had a substantial impact on that revenue that they had anticipated from the reserves. The other thing was the unexpected low lapse rates. Most carriers price products, a long-term care product, initially for about a 4 to 5% lapse rate. And what the carriers have learned over time is that most people don't drop their long-term care insurance regardless of what's happening from a pricing standpoint. Persistency with long-term care is about 99%. So that, coupled with the low interest rates, along with the fact that people are living longer, the longer we live, the more likely it is that we're going to need some type of care. They're also finding that long-term care claims are lasting longer than what is anticipated. So when you kind of boil all of those factors together, that's led the carriers to the point where really, in order to maintain those blocks of business, maintain the obligation to the policyholders, they are basically, a number of these carriers that I've heard in personal testimony before state regulators, they're basically trying to get these blocks of business back to break even. They're not looking to get them to even to a point where they're profitable moving forward, or they're trying to recoup that lost revenue. They're just trying to get those older blocks of business back to a break-even point. The other major thing that's occurred is the gender-based rates. over the last 2 to 3 years, most carriers have gravitated to a gender-based pricing. And, again, that's obviously had a substantial impact on new premiums moving forward. And the other thing that the carriers have done, which, again, if you've sold any long-term care or you selling long-term care today, you know that the benefit options that most clients have are far more limited today than what we had available 10, 15 years ago. There are no more lifetime benefit options, although we do have a carrier actually coming back in the market. We anticipate maybe April, May, that we'll actually have a lifetime benefit. Most of the shorter limited pay options, the single pay, the 10 pays, things of that nature that most carriers had previously offered are no longer available. 5% compound, which was probably the most common benefit increase option historically, is now repriced and in most cases probably priced out of range for most folks. Most folks are buying a 3% compound. So, when you take all of these things into account, along with the underwriting, which is far more stringent today than was available when I started selling long-term care back in '96, it's kind of led us to where we are today. So that's, the thing that I tried to get folks to take a look at and take a step back from is separating that old business from the new business. We can't ignore what's occurred and is occurring on those old blocks of business. Nobody likes to have those conversations with your client when they call and they're getting those substantial rate increases, but again, they have to deal with it. There are ways to try to deal with that, to minimize those rate increases. Again, I can certainly have those conversations with you as to what we're suggesting. But it's also then looking at and separating, okay, well, where are we today with regards to the traditional long-term care products? And one of the biggest concerns, speaking from an agent perspective, that I find in talking with agents is the rate increases. And, I just don't want to have that conversation. I don't want to be put in a position where I have to have that conversation with a client where they're going to get these substantial rate increases. And again, when you look at where we are today in the long-term care market and what these carriers have learned from a pricing standpoint, the lapse rate assumptions that they're using are 1% or less. Obviously, we are in a much more conservative interest rate assumption environment. So the interest rate assumptions that carriers are using today typically is in that 4.5% range, whereas 15 years ago, 20 years ago, that interest rate assumption was typically between 6 and 7%. Again, underwriting is substantially different, and they've got 16 times more policy data and 70 times more claims data than they did in the year 2000. So much, much more mature market. And the Society of Actuaries did a pricing study in 2015, and looking at policies sold in the year 2000, there was about a 40% chance looking back that there was the likelihood of a future rate increase on that business. In 2007, there was about a 30% chance of a likelihood of a future rate increase, and policies sold in 2014, moving forward, there's about a 10% chance of a likelihood of a future rate increase. So obviously you can see that the likelihood of a future rate increase is far less likely today than it was 10 years ago. That's not to say that the client won't have a rate increase, and I encourage every agent to make sure that they frame that expectation with the client that there will be a rate increase, but the likelihood of the rate increases occurring on future business, similar to what has been seen on that old business, is far less likely. So again, I just want to put some perspective on that old business versus the new business today. I touched on the gender-based pricing, and that's been one of the biggest impacts. And again, providing some substance behind what the reasoning was for that. Almost 70% of long-term care claim dollars go to female policyholders. 7 out of 10 women are living single at 75. The longer we live, the more likely it is we're going to need care. Women tend to live longer, so carriers have kind of woke up and recognized that, hey, we need to probably price long-term care insurance in the same manner that we price life insurance. Men pay more for life insurance because we have a shorter life expectancy. Women live longer, more likely to need some type of care. That's where the bulk of our claim dollars are going. We need to reprice long-term care to appropriately address or price that risk. So most of the carriers in our portfolio, all of the carriers in our portfolio except Mass Mutual at this time, are using gender-specific rates. If you have single female clients that may want to consider or should be considering long-term care insurance, now would be the time to have that conversation with them, particularly with Mass Mutual, because they are best in class from a pricing standpoint. Obviously, financially, they are extremely sound, and they've got a very, very reasonably priced product and very fair underwriting. When they go to gender-specific rates, based on past experience of what we've seen with other carriers going from unisex to gender-based rates, when they go to gender-based, those rates will go up 40 to 50% or more for single females. So now would be an opportune time to go back, have those conversations with clients, particularly single female clients, that if they're going to consider long-term care, now would certainly be the time to do that. Just wanted to give you kind of a snapshot of some sales data that I had taken from American Association for Long-Term Care. They do a informational source book every year. This is from the most recent, from 2014. Everybody kind of wants to know, well, where's the sweet spot? As you can see, it's kind of in that 45 to 64 is really where the sweet spot is that people are buying long-term care insurance, and this is traditional long-term care insurance. Benefit periods, typically what we see is 3 or 4 years. Most people are buying a 90 or 100-day elimination period. We are typically seeing anything from $100 to typically $200 a day. That's generally what we're seeing as a benefit. And most of the policies that we see are either a 3% compound or a future purchase option. So that kind of gives you a snapshot of what does the profile look like of a typical traditional long-term care buyer, and what are they typically buying on average from a plan design perspective. Some claims information. Again, I mentioned that 71% of all claimants are female. The other one, you always get was, well, I don't know how long I'm going to need care. And, yes, obviously a care event can be a relatively short period of time, but I think it's interesting to note that if a long-term care claim lasts for more than 1 year, the average length of that claim is 3.9 years. And obviously, most people want to remain at home as long as possible. So it would just stand to reason that the vast majority of claims are started with a home health care claim. And then you can kind of get a snapshot of some other claims statistics there. But again, just wanted to kind of point out some of the ones that I thought were of most interest. The other thing is, we're so involved in our core market, whether again that's life insurance or employee benefits or the Medicare market or whatever the case may be. But again, I think interesting that 86% of men and women say it's important for their financial or health insurance professional to talk with them about long-term care. However, only 9% have actually had their financial or health professional talk to them about that. This was from a survey that AgeWave and Harris Interactive did in 2010. John Hancock surveyed their existing long-term care policyholders, and they indicated that 83% of policyholders indicated that they were the ones that initiated the conversation about long-term care. So again, the takeaway is your clients probably do want to know about what their options are relative to long-term care planning. If you're not asking that question, they're interested in knowing this information, and they're going to ask somebody. Typically, it's the next person, next professional that they talk to after they've had a close personal experience. So if you are not communicating to your client that you have the ability to talk to them about this type of planning and have the ability to provide solutions, they're going to seek that information out from somebody. That could be another life producer, that could be another benefit broker, and if you're not providing that information, that leaves the door open for that other advisor to begin to talk to them about the other products and services that they're able to help that client out with. So this is a great way to make sure that you're building a fence around your client so that they're not getting that information from somebody else. Just a couple, again, quick statistics, which can be a double-edged sword, but again, as I've referenced earlier, the longer we live, the more likely it is that we're going to need some type of care. But also keep in mind that 40% of long-term care services are received by individuals under the age of 65. So that need for assistance with 2 out of 6 activities of daily living is not discriminatory. I mean, I could be 25 in an auto accident, no different than the individual who's 75 or 85 and maybe diagnosed with a cognitive impairment. So a long-term care event can occur at any age, and it truly is, the single greatest risk that clients face financially as they get older, but typically it's the one risk that's left unprotected. I'm sure we've all seen, some of these statistics. There's going to be, or is 78 million baby boomers that began to turn 65, and starting in 2011, it's 10,000 a day, some crazy number like that. And again, 70% of those turning 65 are going to need some type of long-term care at some point in their life. The vast majority of those events won't last longer than 5 years. Obviously, there's the catastrophic events, the Alzheimer's, the Parkinson's, things of that nature that can certainly last longer, but the vast majority of long-term care events don't last longer than 5 years. Just a snapshot of what the cost of care currently looks like across the U.S. These figures were taken from the most recent Genworth Cost of Care Survey. If you're not familiar with that, or you've not visited that website, there's a tremendous amount of information, a lot of resources available. Again, that's just if you Google Genworth Cost of Care, that'll take you to that website. You can pull up any state, within each state, a number of different geographic locations to see what the actual cost of care is today and what that cost of care may look like in the future. Since we're in PA, I just used some average costs in Pennsylvania just to give you a snapshot. Obviously, it's not an inexpensive scenario. And it's important to keep in mind not just what that cost of care is today, but if we're truly doing planning with the client, what's that cost of care going to look like 10 years, 20 years, 30 years down the road? And there are limited ways in which to pay for that. Those of you in the Medicare market certainly know that Medicare doesn't pay for extended long-term care. And in order to get to Medicaid, the client is going to have to spend down those assets and or resources to a point where financially they qualify for Medicaid. Medical is, again, similar to Medicare from the standpoint that, you know, under a major medical plan, it's really not going to pay for, you know, any substantive skilled nursing, and personal and custodial care are not covered either. So from a health insurance perspective, be that under age 65 or over age 65, medical insurance isn't going to pay for it. If I want to get to Medicaid, I've got to spend down my assets in order to qualify financially for Medicaid. Disability insurance, which sometimes gets confused, is, again, that's an income replacement. So my disability isn't going to pay for a long-term care event. Those are additional expenses that I have over and above, you know, whatever my ongoing normal monthly expenses are. So again, I can spend down my money, qualify for Medicaid. I'm going to have limited resources through my medical insurance. I can self-insure, and if we're going to self-insure, again, that's where having that conversation with some of the life insurance and or asset-based products to maybe more effectively and efficiently self-insure. But again, it comes down to how much risk does the client want to take, and just like every other insurance that they have, how much risk do they want to transfer to a private insurance company so that in the event something does happen, they're not taking on 100% of that risk. That insurance is helping to cover some of those costs. We try to emphasize with the advisors and agents that we work with to make sure that you're really approaching this from a planning-centered point of view. This is not a product conversation. This is a planning conversation, and if you're approaching everything else that you do in your day-to-day practice, I should say, I assume you're approaching everything else that you're doing from a day-to-day practice standpoint, from a planning perspective, long-term care is the same. It's really about coming up with a plan, the objective being to allow that client to maintain their independence in the community while preserving the emotional and physical well-being of those who will provide care and preserving the retirement portfolio so it can continue to support the lifestyle to keep the financial obligations. If you've had a personal experience with a family member, a friend, a client that's needed long-term care, typically that planning occurs when the event occurs. If you ask the client where they want to be if something were to happen, if they got sick and needed care for an extended period of time, where would they want to get that care? 99.9% of the time, they're going to tell you they want to stay at home. And if it's a couple, typically they're going to say, he's going to take care of me and I'm going to take care of him. So spouses are going to take care of each other. So really the question comes down to not about insurance, but, you know, Mr. Client, if your expectation is to stay at home as long as possible, what's the plan? Not do you have insurance, or I'm suggesting you get insurance, but what's your plan? And the vast majority of clients have spent more time planning to go on vacation for a week or where they're going to go out for dinner on a Friday night or what movie they're going to see. They've spent more time talking about that than they have about what happens if they get sick and need care for an extended period of time, and how are they going to pay for it. So, going back to those personal experiences, if they've had a personal experience, they understand, they get it, they know what will happen, not only to themselves, but more importantly, if there's a spouse involved, what happens to that spouse if that spouse is going to try to be a 24-hour-a-day, 7-day-a-week caregiver? The caregiver breaks down and can break down quicker than the person that they're providing the care to. So if my expectation is to stay at home longer than otherwise possible, that's going to be dependent on making sure that my spouse and or whoever or whatever that caregiver network is that I have in place, that it's able to structurally stay in place, and I have the resources available to pay for that care to allow me to stay at home. Because as soon as my spouse can no longer do it, or my caregiver network can no longer do it, I'm going to be forced with, or they're going to be forced with the decision to have to put me into some type of a facility setting. So really, when it comes down to it, coming up with a solution, an insurance solution, again, whatever that looks like, whether it's traditional or life or annuity based, it's as much about the benefit being not only for the person who may need care, but it's about having those resources available for whoever's going to be that caregiver, so that they don't have to be a 24/7 caregiver, which will allow that person who needs care to likely be able to stay at home longer than otherwise possible. Again, it really all revolves around having a planning conversation and not just getting a quote and showing that quote to the client so that everybody can check it off their list of things to do and move forward. It's really having a planning-centered conversation. So when you look at designing those plans, again, it can be based on how much benefit do they want, what's their budget. There's a number of different ways to approach it. But as I said, in most cases, we find most people buying a benefit that's somewhere between $100 and $200 a day, 3 to 4 years, with an inflation option. It's not going to cover 100% of the cost, but relative to home health care and assisted living, it's going to cover the vast majority of the cost. And if there is a catastrophic event where there's a skilled nursing scenario, it's going to take a major portion of that burden off of the client's shoulders financially. So again, it's a benefit that makes sense, and it also, obviously, because there's a little bit lesser of a benefit, it allows that premium to be more affordable, more realistic for the client to seriously consider if it's something that makes sense for them financially. The biggest thing, though, that I stress is, before everybody goes too far down the road, is let's take a step back and make sure the client medically looks like they'll qualify or potentially qualify, or at least to the point where, we could seriously considering an application if the client were to want to move forward. When I first started selling long-term care insurance back in '96, typically 80 to 85% of applications were approved. Today, that benchmark has been lowered down to about 60 to 65% of applications are approved. And the older the client gets, the greater that declination rate becomes. So I really strongly encourage the advisors that we work with is, when you're requesting a quote or prior to submitting an application, let's get this long-term care insurance pre-screen form filled out and get a snapshot medically. What does this client look like? So we can do some due diligence in talking with the carriers, make sure that that an application would seriously be considered, because we don't want to take anybody too far down the road if we know that they're not going to be approved, or the likelihood they won't be approved. But also from an underwriting perspective, we want to make sure that we're providing the appropriate carriers for you and the client to consider, and not suggest that you submit an application with company A, where had we known some of the medical information up front, we never would have suggested that carrier in the first place. So again, it's just doing some due diligence up front, just to help make sure that everybody's moving forward with the right expectation. As I mentioned, there's a couple of different ways that that we can address this from a solution standpoint. Obviously there's traditional long-term care products, and that's really, again, the role that we serve for the folks working, for URL and the folks working through that with them. There's long-term care riders on life insurance products and the long-term care linked benefits. Traditional sales over the last number of years has actually been declining, for a number of reasons that we've talked about earlier. That those rate increases on the legacy block and the concerns that clients have surrounding that, the increase in premiums, the challenges with underwriting, but it still can be a viable option for the right client. What has been taking off and getting more interest for a variety of reasons is the long-term care riders, or the chronic illness riders on life insurance products, and the linked benefit policies. That the ability for a policy to provide a benefit regardless of whether they have a claim or not, obviously can have a lot of appeal to the client. Traditional long-term care insurance is like term insurance from the standpoint, with a traditional long-term care policy, I have to go and claim to get a benefit. Term insurance, there's no cash value. I've got to die for somebody to get a benefit. So those life insurance-based products and annuity-based products certainly have gotten a lot more traction over the last number of years. And again, pretty straightforward, just a quick snapshot of that traditional long-term care policy. One of the advantages, though, that I will mention with regards to the traditional long-term care policy is the state partnership program. It does allow clients to protect assets equal to what's paid out by that long-term care policy, so that they don't have to spend those assets down from a Medicaid standpoint. So that can only be done through a traditional long-term care policy. That state partnership protection or benefit does not and cannot be offered on a life insurance-based product. Again, this is being recorded. You'll have access to these slides, but again, just a quick matrix of if your client looks like or is a business owner, traditional long-term care insurance may make sense, at least having that conversation, because of premium deductibility, ability to be selective, does not have to do it for everybody, benefits tax-free. If they like the idea of pure protection, then traditional long-term care may make sense, or if they're concerned about protecting assets because of that partnership program, then a traditional policy, or at least looking at a traditional policy, might make sense. So we did kind of the same thing with the traditional versus a linked. If your client looks like or has concerns about, kind of what's illustrated there on the left-hand side, then that linked benefit approach might make sense and probably should be brought into the conversation and looked at as a potential viable solution relative to the planning. And then just a snapshot of the difference between a long-term care rider versus a chronic illness rider. Again, you can talk with Steve and his team more about that. So talking a little bit about some carrier-specific stuff, obviously Genworth has gotten a lot of attention in the media recently for a variety of reasons. not just relative to their traditional long-term care business and the rate increases that they've had to pass on as a result of those old legacy blocks of business. But most recently they suspended the sale of their life and annuity business and are 100% all in, focused on the traditional long-term care market space and developing products centered around providing a solution relative to the risks and costs associated with long-term care. They're really doing some fairly forward-thinking, aggressive moves with regards to underwriting. They're expanding their underwriting, allowing for some conditions to now be brought into the conversation that otherwise were not insurable or insurable at a higher rate class. They are simplifying the application process, streamlining that, making it much more agent and client friendly, not quite as intrusive, and trying to get that cycle time to a much shorter timetable. So we just actually were on a conference call with them earlier this morning, and I know that there's definitely some headwinds that Genworth is facing over the next couple of years as they try to come out of some of the financial situations that they've been in. But from an ease of doing business and from an underwriting standpoint, they really are putting their best foot forward. Transamerica, great company. Frankly, not doing a whole lot with them on the individual side. They have suspended the sale of their 3% compound, which is their which is actually the most popular benefit increase option, and as a result of that, it's really hurt them a little bit, I guess, for lack of a better description. It's really hurt them with sales because we just don't have that 3% compound benefit increase option available. From an underwriting perspective, though, sometimes we are positioned just because of some of the favorable underwriting that they provide relative to some conditions that other carriers won't look at. Then we're able to pivot to Transamerica. They are one of only 2 carriers that do have a multi-life platform, which is specifically designed for worksite marketing. So they are definitely a player when it comes to the worksite market space. Big advantage for an employer group is that we're required to use the unisex rates, and we can also potentially get some abbreviated underwriting. So anybody doing any business out there with business owners or in that group market space definitely has some voluntary options available relative to traditional long-term care markets, and we'd be happy to talk to you a little bit more about that after the webinar. Mutual of Omaha, right now probably one of our strongest carriers. 2 different products, secure solutions, custom solutions, priced extremely competitive. Again, very fair underwriting, calendar day elimination, pay their benefits on a monthly basis. They actually have a cash alternative for home health care, so for those clients that like the idea of maybe having the availability of some cash and not having exclusions or limitations as to how those dollars are spent, or paying a family member, there's a cash benefit there. So, again, they're definitely, I would say, probably our primary carrier, all things being the same at this time. I mentioned Mass Mutual. Again, the strength right now of Mass, beyond the obvious of their financial ratings, is the fact that they do have unisex rates. So they are extremely competitive in that single female market, as well as with couples. They also, their long-term care policy is actually a participating policy. So because of that, they probably have one of the more premium stable products. In the future with those dividends, if there were a need for a rate increase, there's some flexibility with the ability of the carrier to utilize those dividends to offset the need for rate increases on existing policyholders, which they've not had to date. So there's some real reasons if that client really is looking for, the best in class from a financial rating standpoint, flagship carrier, etc. Definitely want to make sure we look at Mass Mutual as an option. John Hancock, they are aggressively back in the market trying to earn market share that they had lost over the last several years. One of the biggest concerns that we talked about that clients have when looking at long-term care insurance is knowing what that premium is today and what that premium is going to look like in the future. They've rolled out a product about a year ago, Performance LTC, that is the most transparent from a premium standpoint long-term care product on the market. That premium can go up, it can decrease, and it can zero out. But every year, that client will know exactly what that premium is going to look like. And inside the product, it has or will develop what's called flex credits. Those flex credits can be used similar to what a dividend would be in a whole life insurance policy. Those flex credits can be used to help reduce those premiums over time to the point where that premium can actually zero out. And if the client does not use the long-term care insurance, those flex credits can actually function as a return of premium option. So they are, as I said, aggressively trying to regain market share. It's a really interesting product. So again, I'd be happy to address any questions and get any information out to you on that product. LifeSecure, we've just recently added LifeSecure. They've been in the market for about 10 years. They're a wholly owned subsidiary of Blue Cross Blue Shield. They've actually become the #1 worksite long-term care product. Very technology-based, super easy to do business with, very easy for the client to understand. Basically, the client chooses a benefit bank of $100,000 to $1 million, and then they choose a benefit access rider. Do they want that benefit payable from the benefit bank at a rate of 1%, 2%, or 3% monthly? Do they want to add a benefit increase option? That's really the only decisions that the client has to make. So it's a very easy product for the client to understand, and there is a flexible benefit that allows the policyholder to use 50% of any unused monthly benefit on an unrestricted basis, including the ability to pay immediate family members and even a spouse to assist with informal care services. So a really attractive product, not just from a pricing standpoint, but from a benefit standpoint. And Michigan Blue Cross or Blue Shield is actually the largest state Blue Cross Blue Shield in the country. So again, LifeSecure has the financial backing of that particular Blue Cross Blue Shield. So in summary, the key to success is really just starting the conversation. If you're in the Medicare market, you've already had the conversation with your client about Medicare. If you're in the health insurance market, you've obviously had the conversation relative to health insurance, but it doesn't matter what Medicare or health insurance plan you provide your client or that they may have, it does not pay for extended medical care. So you have the opportunity to go back to that client and talk to them about a hole or a gap that they have in their plan that could be and is likely, as they get older, it is the single greatest financial risk that they face. pre-qualify. Use that pre-qualification form. Let's make sure that the client looks like, if they were to want to proceed, that they look like that we can do that. But again, it also helps us in maybe recommending what carrier would be most appropriate to talk with your client about. Again, we can assist with that plan design. If you're just not sure, again, allow us to help you, hold your hand through that process. If you need us to be on a conference call, geographically, if we're in the area, if you want us to meet with you and the client, again, we're here to be a resource. We're here to be the experts so that you don't have to. And be patiently persistent. This is not a one-call close. It can take multiple conversations. But again, just be patiently persistent. Keep it out in front of your client. And know that you have a resource that you can turn to, if and when that conversation presents itself. So again, just a snapshot of that pre-qualification form. And, again, call us for assistance and marketing support. Our number's there. I'm extension 304. My assistant, Kathy Marazzo, is at 305. And again, you can get to us, through the URL website, obviously, as well. So with that, Steve, that's my story. I'm sticking to it. And, if anybody has any questions, I'd be happy to entertain any questions at this time.
Great. Fantastic, Mike. I appreciate that. Appreciate all the great content today. Everyone for attending, thank you. Now's a good time if you do have a question to raise your hand, and we will certainly field any questions. If there was any questions in the, if you type in any questions and submit them that way as well, that would be a great time to do that. Also, just wanted to show you if you're looking to do any marketing towards your client base with long-term care resources, I shared with you here just a couple snapshots from the Life Happens website. URL can provide some great content on long-term care through Life Happens. I always say it's non-denominational. It's not Genworth. It's not John Hancock. It's not Mass Mutual. The content is from a nonprofit, so it's out there and designed for the clients in mind without pushing a product or carrier. It's fantastic content information. We can certainly make it available to you to then send on to your clients. Life Happens also has great content on the life insurance side as well as the disability income side, and we would have resources there for you as well. But again, thank you, Mike. I do see some questions rolling in, and we'll get to those right now.